Did you know that 90% of the world's most successful investors, including Warren Buffett, started with one thing in common? They all swear by value investing, a strategy that looks for stocks priced below their true worth. But here's the shocking part. Most people only know about the famous books on the subject, like The Intelligent Investor. What if I told you there are lesser known, but equally powerful books that could give you an edge in the market? In this video, we're diving into 6 must-read value investing books you've probably never heard of. These aren't your usual recommendations. We're talking about game-changing strategies that most investors ignore. You'll learn how to spot hidden gems, understand the deeper psychology behind investing, and find opportunities in places the average investor overlooks. So, if you're tired of hearing the same old advice and want fresh, actionable tips to take your investing to the next level, stick around. Let's get into it. Chapter 1. The Hidden Gems. Underrated value investing classics. When we think of value investing, books like The Intelligent Investor and Security Analysis often come to mind. But there are a handful of lesser-known books that can transform your investing approach just as much, if not more. One of these is Value Investing, From Graham to Buffett and Beyond by Bruce Greenwald. This book is a hidden gem that introduces a strategy based on deep value. Greenwald offers a clear formula for finding undervalued companies, focusing not just on financials but also on competitive advantages. Another overlooked classic is The Little Book of Value Investing by Christopher Brown. While the title may sound simple, the ideas in this book are powerful. Brown advocates for focusing on buying good businesses at great prices, rather than trying to time the market. He quotes, "Investing is not about finding the next big thing, it's about finding great businesses with room to grow." This simple yet profound approach lays the groundwork for long-term success. Value investing requires more than just financial analysis. The Most Important Thing by Howard Marks is a standout in this category. Marks emphasizes the importance of risk management, saying, "You can make a lot of money, but not if you take too much risk." He explains how knowing when to hold back from investing can be just as valuable as knowing when to invest. This strategy of risk aversion is crucial for anyone looking to avoid significant losses in volatile markets. These books encourage a deeper, more strategic approach to investing. It's not just about spotting a bargain, it's about understanding why that bargain exists and whether it will continue to be undervalued in the future. If you're willing to put in the effort to study them, these hidden gems will change how you view the market. Chapter 2. The Counterintuitive Value Play. Why most people get it wrong. Value investing is about buying stocks at prices below their true worth, right? But what if I told you that some of the best value investors deliberately seek out companies with troubling histories? The Contrarian Investor by Edward Yardeni is a book that flips traditional value investing on its head. Yardeni suggests that market pessimism can often lead to opportunities in companies that are in the midst of restructuring or recovering from failure. His counterintuitive approach teaches investors to embrace uncertainty as a source of potential profit. In his book, Yardeni shares that some of the most successful investments come from ugly ducklings, companies that have been beaten down by the market. He claims, sometimes, the most compelling investment opportunities lie in the places where fear and pessimism are highest. That doesn't mean buying anything that's cheap, it's about buying companies that are priced lower than their potential value after overcoming challenges. Another book that challenges conventional thinking is Common Stocks and Uncommon Profits by Philip Fisher. Fisher's book is often overshadowed by the works of Graham and Buffett, but it's a treasure trove of insights into growth and value investing. Fisher's strategy doesn't just focus on undervalued stocks. He also emphasizes the importance of investing in companies with strong, long-term growth potential. His philosophy is clear. Invest in companies with a competitive edge that allows them to grow for years to come. This approach flips the script by marrying growth and value investing into a cohesive strategy. The lesson here is clear. Value investing isn't about blindly seeking out companies with low stock prices. It's about understanding the underlying dynamics of the business and its industry. If the market is overly pessimistic, that might just be the best time to make a move. Chapter 3. The Art of Patience. Books that teach you how to wait for opportunity. Patience is one of the most overlooked virtues in value investing. We often hear that the best investors are those who can wait for the right moment, but how do you actually do that? The Dundo Investor by Manish Pabrai offers a simple yet powerful framework based on the idea of heads I win, tails I don't lose much. This strategy is centered around making bets where the upside is substantial and the downside is minimal. Pabrai believes that one of the best ways to minimize risk is by investing in companies with predictable, stable earnings. Pabrai's approach is built on the idea that value investing is not about finding short-term gains, but rather about identifying long-term opportunities where patience is key. He stresses the importance of waiting for market mispricings. His rule? Be patient, let the market come to you. In this chapter, patience doesn't just mean sitting idle. It means being selective and waiting for the right moment when the risk-reward ratio is in your favor. Another great book that teaches patience is The Psychology of Money by Morgan Housel. Housel takes a broader approach, blending psychology and finance to show how emotional discipline can be just as important as financial acumen. His advice is clear. You are not a failure if you don't make money every year. You are a failure if you don't have a plan to keep your money safe. Housel's emphasis on avoiding panic during market downturns is a key takeaway for anyone looking to build wealth through value investing. These books demonstrate that being patient isn't about sitting on your hands, waiting for opportunities to magically appear. It's about being selective and confident in your investment choices, knowing that good opportunities don't come every day. Value investing isn't a race, it's a marathon. Don't forget to subscribe for more value investing strategies that could change the way you think about investing. Chapter 4. The Deep Dive. Understanding intrinsic value like a pro. When it comes to value investing, calculating intrinsic value is the holy grail. But what does it really mean to calculate intrinsic value accurately? In the Little Book of Valuation, Aswath Damodaran breaks it down. He's one of the leading experts in valuation, and his approach is grounded in real-world scenarios. According to Damodaran, understanding intrinsic value requires more than just numbers. It's about understanding a company's future cash flow potential and the risks that come with it. Damodaran explains, valuation is not about finding the right answer. It's about finding the best estimate of future cash flows based on current information. He encourages investors to focus on understanding what a company will earn over time, rather than just looking at short-term metrics. Damodaran's method is rooted in discounted cash flow, DCF, analysis, which can be applied across industries and businesses of all sizes. One of the most interesting aspects of his approach is the growth versus value debate. He argues that valuation isn't just for finding undervalued companies. It's a tool to identify opportunities, whether the company is undervalued or overpriced. Damodaran stresses that even high-growth stocks can be evaluated using these same techniques, challenging the notion that intrinsic value only applies to mature companies. In Security Analysis by Benjamin Graham and David Dodd, the concept of intrinsic value takes a slightly different approach. Graham focuses on the margin of safety, which refers to the difference between a stock's intrinsic value and its market price. Graham's strategy is simple but effective. Only invest in companies where the market price is significantly lower than the intrinsic value. This helps protect against market fluctuations and the risk of misjudging a company's worth. Graham's classic advice, the investor's chief problem, and even his worst enemy, is likely to be himself, underscores how important it is to be disciplined in your valuation approach. The margin of safety concept helps investors avoid risky investments that could lead to losses. Whether you're using a DCF model or a margin of safety approach, these books demonstrate that understanding intrinsic value is key to making smarter, less risky investment decisions. Chapter 5. The Psychology of Value Investing. Books that reveal investor mindset. Investing isn't just about numbers, it's also about understanding human psychology. In The Psychology of Money, Morgan Housel explores the emotional side of investing. Housel argues that successful investing isn't about being the smartest, it's about managing your emotions and avoiding rash decisions. He writes, doing well with money has little to do with how smart you are and a lot to do with how you behave. This means staying calm in market volatility and resisting the temptation to make emotional, short-term decisions. In his book, Housel highlights how psychological biases, such as overconfidence and loss aversion, can cloud an investor's judgment. He uses the example of a person who sells a stock in panic after a small dip, only to watch it rebound a few months later. The lesson? Don't act on fear, trust your analysis and stick to your strategy. Housel's advice helps investors control their emotions, making them more likely to stay on course even when markets are unpredictable. The Behavior of Individual Investors by Brad M. Barber and Terence O'Dean also delves into the psychology of investing. Barber and O'Dean conducted a study of individual investors and found that those who traded most frequently actually underperformed. The more active investors tried to beat the market by jumping in and out of stocks, but in the end, they missed out on the steady, long-term returns that come with patience. The study showed that long-term investors who stick to their strategy tend to outperform short-term traders. The key takeaway from both Housel's and Barber and O'Dean's work is that your mindset can make or break your investing success. By keeping emotions in check and focusing on the long term, you can avoid common mistakes and capitalize on value opportunities. Remember, value investing is not just a strategy, it's a mindset. Chapter 6. The Global Perspective. Value investing insights from different cultures. Value investing is often associated with Western philosophies, but global perspectives can offer fresh insights. In The Value Investor by Guy Thomas, the author highlights how investing practices in Japan differ from Western norms. Japanese investors have a unique appreciation for stability and long-term growth, which can provide valuable lessons for Western value investors. For instance, Japanese firms tend to focus on maintaining strong relationships with employees, customers, and suppliers. This commitment to stability is reflected in their financial reports, making them more predictable in terms of long-term growth. Thomas argues that Western investors can learn a lot from Japanese companies by focusing on businesses that emphasize loyalty and consistency. These companies may not show explosive growth, but their resilience and solid foundations often lead to steady, long-term returns. He emphasizes the importance of looking beyond the numbers and considering the cultural values that shape a company's operations. In The Art of Value Investing, John Hines and Whitney Tilson take a global approach by interviewing some of the world's top value investors. One of the key takeaways is how global markets offer different opportunities. For example, emerging markets often provide undervalued companies with huge growth potential. Hines and Tilson discuss how investors can benefit from looking outside their home country to find value in places others might overlook. Hines shares a valuable insight: the most exciting opportunities are often in places where no one else is looking. Emerging markets like India, China, and parts of Africa are filled with companies that have been undervalued due to regional instability or a lack of interest from Western investors. These regions present risks, but with the right research, they can be gold mines for value investors willing to take the time to understand local dynamics. The global perspective teaches that value investing is not limited to the stock markets of the US or Europe. By considering cultural factors, international markets, and different approaches to business, investors can discover new opportunities in overlooked places. By expanding your horizons beyond the local markets, you can uncover hidden gems that others might miss. Don't forget to subscribe for more value investing strategies that could change the way you think about investing.